And to help break down some of this economic jargon, I'm now joined by Edward Yardeni. He's the president of Yardeni Research. Thank you so much for coming on the show, sir.
Sure, thank you.
I just want to start by discussing, talking about the disconnect that we're seeing for a moment between Main Street and Wall Street. So U.S. GDP shrunk by 0.5%, more than estimated, largely over consumer spending, which was revised significantly lower by just 5%. So yet we look at the Nasdaq and S&P at or chasing record highs. So consumers aren't spending, businesses aren't hiring. Powell says look for unemployment to tick higher into the end of the year. Why is there such a big divergence?
Well, the data's been a little funky since the beginning of the year. We had a really cold January and February, and that really depressed consumer spending. Then it picked up somewhat in March, and then we did see some decent pickup during the second quarter. So the second quarter numbers should be pretty good. I mean, the Atlanta Fed's GDP now tracking model is looking at something like 3.4% for real GDP in the second quarter. So I think we just need to kind of average the first and the second quarters. The labor market still looks fine. I mean, the initial unemployment claims suggest that people aren't getting fired. There's no real issue with layoffs, maybe here and there in a few areas, interestingly in technology, where some jobs are being replaced by AI. But other than that, we're not seeing layoffs. What we are seeing is it is taking a little bit longer for somebody who's unemployed to find a job, but the unemployment rate is 4.2%. In June, it might go up to all the way up to 4.3%, and we're still going to be basically at full employment. And then, of course, in the near term here, we may see a little bit of a pickup in inflation related to tariffs. All in all, I think the bottom line is the economy is resilient, and the stock market is reflecting that expectations that the resilience will continue through the end of the year. No recession.
Edward, I want to push back just a little bit on that, pick up on something you said. So the Atlanta Federal Reserve forecasting GDP accelerating at a rate of 3.4% this quarter. But how reflective really is that of where the U.S. economy is? Because exports are dwindling. Front-loaded imports to get ahead of Trump tariffs are now ebbing.
Correct. Yeah, I think, as I said, you really need to average the first and the second quarter. So if we get something like, I think basically we're looking at about 2% growth in the first half of the year. But the year-over-year comparisons, I think, are worth watching, because the year-over-year has been actually hanging in pretty good, around 2.5% to 3%. And we got a little bit of near the end of the bottom of that range, perhaps during the first half of the year. But I think it'll pick up. There's a lot of consumers that are baby boomers that are retiring now. The baby boom generation is sitting on $80 trillion of net worth, and they saved all that to spend during retirement. So that makes consumers less interest rate sensitive and more likely to keep spending on the areas where employment has been growing, like healthcare, like leisure and hospitality, and that's keeping the economy growing. Capital spending, I think we have to look at technology spending now accounts for half of capital spending, and that's also not interest rate sensitive, and that's also been very, very strong. So I think, you put it all together and you got an economy that's probably still on a year-over-year basis going to show a 3% growth rate this year, and some of that's going to be productivity, some of that's going to be labor input.
So no recession, but what about interest rate cuts? Because Trump has been screaming for interest rate cuts, right? Eviscerating Jay Powell for being too late.
Right.
Do you think he's right? Is the Fed too backward looking? And when do you think they should start cutting? Would they only do it to stave off a recession, or,
Well, let's face it, everybody in Washington would like to have lower interest rates, because we're already looking at $1 trillion, basically, and over a 12-month period in net interest expense. So that's the problem that you get into when you owe more and more debt. You owe more and more interest. And by the way, that's been one of the sources of stimulus. A lot of the baby boomers that have fixed income securities are getting a nice windfall from these high interest rates. But you're right. I mean, Trump wants lower interest rates. But I think Powell is doing a good job by trying to balance the unemployment rate with the inflation rate. Look, the unemployment rate's 4.2%. Maybe it'll go up to 4.3, 4.4%. The inflation rate is currently, let's say, 2.5%. Maybe it'll edge up a little bit, then come back down. We're in nirvana. This is where we're supposed to be. And if we're in nirvana with, basically full employment and very low stable inflation, interest rates are where they should be. But there is this drumbeat in Washington, particularly coming out of the White House, for lower interest rates. And I still think it's going to be none and done for the year, but I'm not going to be too hard fast on that idea. I think July or September we could have a quarter point rate cut. But if you listen to Powell, it sounds like if we have a quarter point, it'll be in September.